Welcome to the 9th episode of How to thinkScript. We are TOSindicators.com, home of the Volatility Box. Using the Volatility Box, our profits for the month of September were a little bit more than $15,500 trading 2 contracts in a small account. Our goal is to make the Volatility Box the single most powerful indicator in your trading arsenal and one of the best ROIs that you can make. Sign up for a 30-day risk-free trial at our website, TOSindicators.com/volatilitybox. Start trading with an edge, at the edge. With earnings around the corner, in today's video we're going to be building our very own Smarter Earnings indicator. But first, an announcement. You asked for it, so we built it. Many of you emailed us asking if there was a way to customize the V-score so that you could see the price at any given standard deviation, not just the built-in ones that we had originally. So we built that new feature into the V-score indicator and went ahead and updated it. So now you can go ahead and input any custom standard deviation that you'd like. Just make sure you choose the custom option in the dev stop window, and then you can go ahead and input whatever the value is of the V-score. And that will then plot the actual value of the price at that given time. And so you can download this latest version of the indicator on our website, tosindicators.com/indicators/vscore. And of course, it's completely free. Okay, now onto our Smarter Earnings indicator. There's quite a few resources already out there on how to analyze pre-earnings optimism headed into and after earnings and trying to buy dips on those sorts of trades. So let's not try and rehash that. I think there's some phenomenal resources already available, but instead, we're going to be building an indicator that focuses only on the day of the actual earnings. That's right. I want to build an indicator that helps me trade price action immediately after the actual earnings report comes out, and this is obviously during market hours. So for example, if earnings came out pre-market, then I want to be able to trade that following day. And if earnings came out post-market, so let's say came out post-market yesterday, then I want to be ready to go for, let's say, today's trading activity using this indicator. And so what you can see off of my charts is that there's really two components of this. There's first the labels at the very top, and this will plot for all of the stock tickers that you're looking to get. And then we also have chart bubbles on the actual chart so that you can go back and very quickly see the two types of trades that we at least look at to see what happened and observe any patterns or so on and so forth. Okay, so let's start with the tree diagram to discuss what the specific indicator will be focusing on. I care only if we have the actual earnings data released, and so for that I care about the actual day of the earnings. And once I have the day of the earnings, I want to check whether or not we had a gap up or a gap down. And really these are the two first variables that I'll use to divide the earnings into two groups, at least for this specific indicator. Now let's say that we actually had a gap, then I'm looking to see whether or not we had either a gap up or a gap down, because a gap now starts to give me an edge, at least information that I can gather from this indicator. And if we had no gap, then I'm essentially going to do nothing, at least in this specific indicator or for the purposes of this. Right? So now let's imagine that we've had a gap up, earnings has come out, we've had a gap up. Now I want to see whether or not we typically fill these gaps, or if we gap up and then we just continue to go from there. Right? And so what would make sense using at least common sense is if, let's say, we gapped up and then we come fill this gap, did we fill that gap because we had a miss in earnings? At least that's what might give us more confidence, right? At least if we had that data point, then if we knew that we had already gapped up and we had missed on the actual earnings, we might be looking for price action to fill that gap. Versus, let's say we gapped up and then price continued to just rise from there. Did we actually beat, was it an earnings beat? And is that why we essentially already gapped up to start off and then we continue to drift higher? And that's what we're looking to see, and we're going to build stats around each of these using historical earnings to give us the confidence as to whether or not a specific stock has a personality. And we'll look at Roku as an example in just a second. But conversely now, if we gapped down, I want to know, did we gap down, and then are we continuing to just go from there, which we're calling our gap and go? And if that were to happen, what you would expect is that we had an earnings miss, which is furthering the bearish trend. Or did we have a gap down and then we filled that gap immediately, which then tells us, did we actually have an earnings beat? And so we gapped down, and that gave us then the confidence to buy this dip, looking for us to then essentially fill that gap if in fact it was a beat. And so now if we take this, all this information, we have this ready to go before a company's earnings. We can use our stats to build a game plan ahead of time, and then we can actually execute the game plan that we have. So let's take a look at, let's say, the case of Roku, right? And so using this chart and this indicator, this is a 2-year chart, I believe, 2 or 3 years, but we're on the daily. And so using that, we have this data already plotted, right? And so this data then tells us that we had a total of 8 earnings, of which we gapped up once, in which we filled that gap. So we gapped up and then we filled the gap down, which we can see is marked by this white bubble right here, where we gapped up, and then you can see that price had actually filled that gap. But the real piece of data that I find interesting here is that we had a total of 7 gap and goes, and out of those 7, 5 of them were in the bullish scenario, right? So this already sort of starts to tell me that Roku tends to gap up and just go in the direction that it gaps, and more times than not, it gaps in a bullish direction. And anytime that it does gap up in the bullish direction, on average, we tend to move about $7.40. Right, and that's what this information tells me, and then I can now go back on the specific chart and start to see all the times that we've, say, gapped up and gone on a bullish scenario. I can see when that's been true on a bearish scenario. And you can see this is the one false signal, and you'll also see that this code does have a few glitches, but that's why we plot these chart bubbles, so that you can then go back in time and start to see, okay, well, what are statistics saying, and is that actually what happened? My goal with this indicator is really to help us prepare, plan, and then execute on this plan. And so if we take this indicator and we turn it into a practical application, one potential use case scenario might be where you scan for stocks with earnings coming up. You might, say, be interested in a stock with earnings coming up in, say, the next 2 days or the next day, because really this indicator helps us just with the actual day of earnings. And so this might help you then you might want to start to scan for stocks in which earnings are coming up. And then with that, you can plot this indicator and create an if this, then that plan, essentially, which is a written game plan in which you might say that, okay, if we gap up and we have an earnings beat, and let's say in the case of Roku, when both of those are true, we tend to then trend for the rest of the day in the bullish scenario. Well, you can already have this game plan ahead of time and then look for scenarios once earnings actually comes out and you have that data, right? And so once you have this game plan, you might then just be looking for confirmation that, yes, does Roku in fact gap up, and did we in fact have an earnings beat? And if both of these are true, then you follow your game plan, and this indicator lets you then start to build out or execute whatever trade idea that you might find appropriate for your account size and your risk tolerance, whether that's options, playing with the actual stock, whatever that might be, butterflies, you name it, right? And so specifically for Volatility Box members, on either Tuesday or Wednesday, we'll be releasing a video just for you guys in which we share some scans that help you execute on this sort of a game plan, at least based off of what we're looking for. And we'll make this into a video so that you have just some ideas of how you might be looking to try and use this indicator. All right, but for all members, this indicator is available for download for free on our website. If you'd like to skip this entire tutorial and just start using the indicator, you can go ahead and visit our website at tosindicators.com/indicator/smarter-earnings, and you can download the code file there. But if you'd like to see how we actually build this indicator, then stay tuned and we'll go through an example of how we coded this up. Okay, let's get started with some actual code. We'll head on over to our charts, click the studies icon, and click create. We'll give the study a new name. We'll call it TI Smarter Earnings, and we can start off with writing some actual code. So the way we'll try and build this is so that we can build on this indicator in the future, even after this video, and make this sort of one big, just smart earnings play indicator. And so as a result of that, we'll try and build everything in a modular fashion. Modular in the sense of we'll divide it into groups. And so in this particular case, we have 2 strategies that we're going to be plotting, right? And we covered this in that tree diagram, one of which is the gap fills, and then one is a gap and go. And so we'll divide each of those into their own modules, along with some global variables in which we'll define the earnings based off of its before market or after market, things like that. And you'll see how we do this. Okay, so we'll start by actually defining our global variables. And so we'll give this a header of like a commented out header, and we'll say global variables. And the first variable we'd like to define is obviously the actual earnings day. And so we'll say earnings day has earnings. And you may notice that there might be some code in which we've purposely split it up in a few different variables. It could have been combined, so on and so forth. And this is that whole idea where we've purposely broken out every little piece that we can, just in case we'd want to reference it in the future, just so that we have almost the most atomic level of these pieces that we could in our code, as opposed to one variable, say, that might have 3 or 4 conditions that are tied to it. Right, and so we'll start with the earnings day. Then we'll define the before market earnings. So we'll say def before market earnings, and we'll say has earnings. And the way to decide if it's a pre-market earnings in thinkScript is to then give this earning time dot before market, and we'll close this out. That should compile, and then we'll go ahead and do the same thing for after market earnings. And so we'll change this to after earning time. And we want this before to say after. All right, and then the next variable that we'll decide is where we group together anything that has the earnings day, and if it's a before market earnings. And so we'll call it def group. So before market earnings. So these are all the tickers essentially that would have before market earnings. This is what the code that it would read. And so we'll say group is equal to, so if it's earnings day, and if it has pre-market earnings, then I want this group to essentially be true. And if it's group aftermarket earnings or aftermarket hours, we'll say earnings day, and we access the previous bar, and then aftermarket earnings. Close that out. And then we'll make one group, which is just all of these tickers combined for things like summing, so on and so forth. And so we'll say def earnings group, group BME, or group AME. Right, and then while we're here, we'll create our first variable that will at least be plotted as a label, and that's the total number of earnings period on the chart that you're looking at. So if you're looking at, say, a 1-year chart, you'll see the number 4. If you're looking at a 2-year chart, you should see 8 earnings, so on and so forth. And so we'll say def total earnings, and for this we'll use the total sum function, and we can just sum up all of the total earnings day. That is a variable that we defined at the very top, and this should then give us all of the variables. And so now, if we'd like to just build this in a way that we can test as we go, we'll create a variable called add chart bubble, and then we could say, let's just, in this case, we'll say earnings group. So if it's before or after market earnings, plot this at the close. And I'd like to see if it's, let's just say, earnings group once again, and then we'll say color.yellow. And what we should hopefully see once we click OK and apply is we have a one bubble plotting any time that we have our actual post earnings day, or our earnings day, in the case of AMD, where if we hover over, we see it reports after market hours. And so we see it's the next bar that's the one that actually has the number 1, the chart bubble that we've identified. And so we know that this code works the way we think it should. So let's now keep continuing on. We'll leave our add chart bubble there, but we'll just comment this out to use anytime we'd like to test in the future. And so we'll now define estimated earnings versus actual earnings, which is also part of our tree diagram. And so we'll start by defining estimated earnings. And so there's a function built into thinkorswim called getEstimatedEarnings. And so we'll use that, and we'll make sure we reference the previous variable in the case that there is no estimated earnings on the current bar. And so we'll say if is then getEstimatedEarnings, then we want it to be estimated earnings the previous bar, else get the actual estimated earnings, the method, close that method out, get estimated earnings. Okay, and then we'll define actual earnings in a very similar manner. So we'll say actual earnings if is nan, and then we'll say get actual earnings here, then actual earnings the previous bar, else get actual earnings, which is another built-in method in thinkorswim. We'll close this out. And now we'd like to actually define if it's a beat or a miss, right? And so if it's a beat, we'll say def earnings beat. And then if it's earnings group, And so this way we know that it actually has earnings and it finds automatically the right bar based on if it's after market or before market bars. And we'll say, and our actual earnings is greater than the estimated earnings, which is how we'll define a beat, else 0. And then we'll say def earnings miss. And once again, if earnings group, and then in this case, actual earnings is less than estimated earnings, and so that's a miss in our definition. And so now we have both our estimated and actual earnings plotted along with the earnings beat and the earnings miss. And so we can once again test this out. And so we'll just type in, let's say, earnings beat, close earnings beat, and this should just plot anytime we've beaten. AMD's beaten, and let's see if that's true. Okay, so in this case, actual earnings was estimate was 0.097, actual is 0.11, and so we beat. And let's see if we take a look at this variable as well. Actual was 8 cents, estimate was 7 cents, so we did beat. Okay, so we know that this is working the way it's supposed to. And once again, we can mute this chart bubble variable and keep moving forward with our definitions. So next, we'll go ahead and define gap fills. So we'll say gap fills. The abandoned baby. Okay, so gap fills, and so we'll start by first defining a gap up. And the way we'll do that is say we'll get def gap up, and once again we can use that handy dandy earnings group variable that we created, and we'd like to see if the open of the candle after we have the earnings data is greater than the previous high, so the previous candle's high. And so we say it's definitely going for the candle to have gapped up. Our open needs to be above the previous candle's high, which is, just to clarify, not the close, not the low. It's not the close, I think, which most people would expect, but we're purposely choosing the high so that we have almost an exaggerated gap up whenever possible. And then we'll say then 1, else 0. And now we'll define gap down in a similar manner. We'll say if earnings group, and in this case, open is less than our low of the previous candle, then 1, else 0. And now we'd like to see if we filled this actual gap. So we'll say def gap up filled if, and then we'll say gap up and our low. So now if you could imagine, we have gapped up and we need to fill the gap. And to fill the gap, price needs to come down. And so we want the low to be less than or equal to the previous high, which is where our condition was in our first candle for the gap up. And if that's true, then we'll say 1, else 0. And then we'll do the same thing, gap down filled. And so if we gap down and our high is greater than or equal to the previous candle's low, so essentially we've gapped down and price needs to travel up in order to fill the gap. And so that's why we're looking for the previous candle's low. And we'll say then 1, else 0. Okay, and so now we have both our gap up and our gap down filled. Now we also need to bring in our earnings, right? And so now if we say def gap up filled, and so if our gap up was filled, for that to happen, price would have to travel down. So we'd have to have gapped up and then price started to crash down. So that means we would expect there to be an earnings miss. And so we'll say and earnings miss. And we'll say gap up filled and earnings miss. And we can easily reference this variable because we defined it up here, right? And so now we'll continue to do this with, so def gap down filled and earnings beat in this case because price traveled up. So gap down filled and earnings also beat, then this variable will be true. And now we can start to define some of our total subs. So we'll say def total gap up fills, and so this could be total sum of gap up filled, right? And then def total gap down fills, total sum gap down filled, Okay, and then we can also create two more variables. One is in which we essentially had a gap up that did not fill. And so this way we have the antithesis of both of these, and we can easily just create those variables while we're here. So we'll say def gap up did not fill, and we'll say, so this is where we gapped up, and our gap up did not filled. And so that's how we can reference it by putting the exclamation mark. We say that this part has to not be true. And then we can also reference the def gap down did not fill. And we'll say the same thing. So gap down and gap down filled. Okay, and one more. Actually, we need to continue going down this total sum path where we have our total sum of the gap ups, where we also had the earnings misses. And so we can say def gap up fills on miss, and we'll say total sum of the gap up. Actually, we can just copy and paste this. So gap up and filled on earnings miss. And then we can create one more variable called gap down fills on beat, and we'll say total sum, and then we take the variable gap down and the earnings beat, and we want the total sum of all of that. And so that should now give us our two total sums. And then our last one variable that we may want to create after having our gap up and our gap down infill is one that combines the two of them together if we'd like to ever reference them in the future. And so we'll say gap did not fill period. And so that will be gap up did not fill or gap down did not fill. Right, and we can close that out. Okay, perfect. And so now we have all of our gap fills. We can test this out. And so if we say bring this variable back out, and let's just check to see, let's say a gap up that was filled. And so we'll say gap up filled, apply. Do we see any instances on AMD? Maybe not. Oh, there we go. Okay, so here's one instance where we gapped up and then we filled. Perfect. And so that's working the way we expect it to work. Once again, we can shut off this test variable. And we've tested all of these out, but in actual coding, so if you guys are doing this step by step, you may find it useful to just test each variable as you go if you'd like to see what each new condition does in terms of the incremental filters that are added in all of these tree diagrams, essentially. Right? Okay. And so now let's keep moving on to the second part of our strategy, which was the gap and go. And now what we'll do is we'll build out this part of the tree diagram, which is the gap and goes, in which we're looking at the earnings beats and then the earnings miss. Okay, so we'll say gap and go. All right, and so we'll start with def gap and go bullish. And we'll say if, and so here for a gap and go bullish, we would expect if price is already gapped up, we expect an earnings beat if it's going to continue in that bullish direction. And so we'll say if earnings beat and gap up did not fill, then 1, else 0. And now we'll say def gap and go bearish. We'll say if earnings miss and gap down did not fill. And so this is where we gap down and price just continued to go down. Then we would expect, we'd call that a gap and go. And so we'll say if that's true, then 1, else 0. And now we'll once again bring in our total sum of both gap and go bullishes and gap and go bearishes first. So we have a total sum variable for both of these as a strategy. And so we'll say def total sum gap, and we'll just start to call this gap G and G here on out. And so we'll say total sum gap and go bullish plus total sum gap and go bearish. Right. Okay, and so now we can also get a total sum of just the bullish trades and just the bearish trades too. So we'll say total sum G and G bullish, and we'll say, and we can just copy paste this actually. So we want just a total sum of the gap and go bullish, and then we can copy paste this once, and we say the same to be true bearish. And so we'll change this to now also say bearish. And we have both our gap and go bullish, gap and go bearish, and we also have our two sums. Now what we need to do is go ahead and calculate our average post move if it's a bullish scenario, and then our average post bearish move. So what does price do in that same candle? What's like the lowest it goes essentially if we had a bearish gap and go, or if we had a bullish gap and go, what is the average that we typically go on the bullish side in terms of how high does price actually travel? Right? And so to define that, we'll say def average post bullish move. If gap and go bullish, then high minus open, else 0. And so we're measuring the distance of how high did it go, so the high of that candle after the earnings, minus where we open from, which is where I would expect that if you had the signal ahead of time, then you could essentially just check to see whether or not if it beat the earnings and whether or not we had like a gap up filled or not. And that sort of lets you start to act right away. And so we'll use the open price. And then we'll say def average post bearish move. If gap and go bearish, then we'd like to see the open minus low, else 0. Okay, and now we can take this one step further and start to actually calculate a true average of this. And we'll calculate an average the manual way, in which we take the sum, then we have a counter variable, and then we'll take the sum divided by the counter variable to create then our average move in the bullish scenario and then the average move in the bearish scenario. And this just gives us our one calculation, but we like to now take our average over, say, the entire duration of the chart. You might be looking at a 2-year chart, so you'd like a 2-year average. If you're looking at a 5-year chart, you can get a 5-year average, so on and so forth. Right? And so to do that, we'll say def sum average bull. We'll say total sum is average post bullish move. And so this now takes the sum of all of the average dollar moves post a bullish gap and go. And then we'll say sum average bear, total sum average post bearish bearish move. Yep. And then we'll also now say def counter average bull. We'll say total sum. And so to do the to build a counter, we can just take a sum of all of the gap and go bullishes, because that we've given a counter of 1, and so each incremental one is just acts as a counter, and so this gives us the total number of instances that we're looking for. And then if we wanted to do the same thing for the bearish side, so we say counter average bear, total sum gap and go bearish. Okay, and then now we'll actually bring both of those together to calculate the average. And so we'll say def post average bullish move, and then we want to take the sum of the average bull divided by the counter of the average bull, and that's our average for that. And we'll just copy paste this for the last one and go through and change all of the bullishes to be bearishes. And so bearish, sum average, bear, counter average, bear. Right, okay, and so that now gives us all of our variables that we care to look at, and we can now just measure or check this variable one last time before we head on over to actually create our labels to assemble our first batch of indicators that we'll cover in this tutorial for the earnings as labels. And so we'll measure this last one, and let's just say we'd like to measure the gap and go bullish. And so we'll say gap and go bullish, gap and go bullish. And if this is true, all right, so gap and go bullish, where we gapped up and we had an earnings beat. So 14 cents compared to 13.138. And so yes, we did beat, and then we gap, and then we continued to go. And so this is exactly what we'd expect from that variable bunch. And so we know that this code is working the way we expect. So now let's go ahead and plot these all out as variable or as labels and chart bubbles, just like this one, but that actually convey information that we care to look at. Right? Okay, and so we'll start with our first label, which is we'll say just the total earnings label, and this is going to be true regardless of whichever strategy you're ever looking at. And so anytime we add a new strategy, we'll give it a label chunk Boolean variable of itself. And so in this case, we have two strategies, the gap fill and the gap and go. And so we'll create a label for each of those. And so let's actually do that first. And so we'll come up here, we'll say user inputs, we'll say input gap fill labels. We'll say yes, so it's on by default. Get rid of the abandoned baby, and then input gap, and then we'll say gap and gap and go labels, and we'll say these are on by default as well. Fix that spacing. Okay, and we come back down here, and so that first variable for total earnings, we want to plot if we have either the gap fill labels to be true or the gap and go labels to be true. And then we'll want the text to say total number of earnings, and then we'll say plus total earnings, and then we can give this the color white. Oops, labels. All right, perfect. And then now we'll go ahead and add in our next batch of labels, which are all around the gap fill labels, right? And so here we'll say add label, we'll say gap fill labels, and this is why we add this as a Boolean. So if you ever say wanted to turn off the gap fill labels, maybe that doesn't fit your trading style, or maybe you've already decided your strategy and you just don't want the noise on your chart, then we can just easily turn off that one chunk or the strategy that you don't care about, or just turn on that one strategy you care about once we start to add more chunks over the course of the next several months or years, whatever it ends up being. So we'll say gap fill labels, and we want to first plot the total number of gap up fills. And so we'll say plus total gap up fills, and we'll plot this as, say, cyan, maybe. Okay, and now we'll go ahead and do the same thing, and we'll keep them all the same color in this case, and so we'll say gap fill labels, and now we want to measure the gap down fills. And so because of the way we name these variables, it's super easy to just come in and just change what you'd like to see plotted. And we have them all defined up there, and so the label code just becomes much, much cleaner. And so we'll say total, and now, so we have both the gap up and the gap down fills, and now we'd like to bring in that earnings miss or beat, and so we'll say gap up fills on miss. And so here we'd like to see gap up fills on miss. And then we can copy and paste this in one more time, and then we'll say gap down fills on beat, and then gap down fills on beat. All right, and that now gives us all of our gap up fill variables. And now we'll go ahead and do the same thing, but for our gap and go variables. And so we'll say add label, gap and go labels, which is the variable that we gave this right a few minutes ago in the input section. And our first one we'll say is the total. Let's add that in here too. We'll add in one more, which is the add label, gap fill labels, and we'll say total gap fills, and we can say total gap fills. I think we created that as a variable, maybe not. We'll see. Let's comment this out to just test that out real quick. I want to make sure that, yep, okay, yeah, so we did not give that the right name. And so total sum gap up filled. Huh, we didn't actually calculate that, I guess. So let's go ahead and do that. So we'll say def total gap fills, and we'll give this total gap up fills plus total gap down fills. Right, and so we'll say total gap fills, and so that now takes care of that variable. And now let's go ahead and add that same variable for the gap and go variables, or labels, sorry. And so we'll say total gap and go we'll just say gap and go, and then plus total sum gap and go, and then we'll give this the color yellow. We may need to play around with the color some more. Total sum gap. What do we call this? Total sum. Oh, yep, we called it total. It's G and G. All right. And now if we come back here, so now we can actually let's just copy paste this in. And so now we can start to break down our bullish G&Gs and our bearish G&Gs. And so let's save some space and we'll say G&G bullish. And so this is equal to total sums G&G bullish. And now we can do the same thing with our bearish labels. And we change this variable to say bearish, color.yellow. And then we can also add in that bullish move that we had calculated, the average move after a bullish scenario and the average move after a bearish scenario. And so we'll say add, actually we'll just copy paste that in one more time, except here we'll say def average bullish move, and then we'll also give this a $sign, and we'll say plus round, and we'll call it post average bullish move, and we'll round it to 2 decimal places, and we can get rid of that, and that should be plotted as color yellow once again. And then if we do the same thing, but for our bearish scenario now, so bearish and bearish. All right, and so that should be most of our labels. So let's go ahead and check to make sure that that is plotting the way we expect it to plot. So we'll hit OK. Okay, so first let's check what we have up here. So we have total number of earnings 12. The total number of gap fills are 1, and so we should see 1 plus 0. Perfect. And on that one gap up fill, it was in fact on an earnings miss. And so that's how we can read this almost as a story. And then we see that we had 7 gap and goes, of which 4 were bullish, 3 were bearish, and the average bullish move was 84 cents, while the average bearish move was $1.14 in that same candle. Right? And that's what this information in the label tells us. But now we'd like to see this on the charts as well. So you might want to go back and study, say, the specific scenario if you might be thinking that we may not get a gap fill, or if, say, AMD did have a tendency of having a gap fill, that might be something you're on the lookout for. Or if we go back to our favorite Roku, for example, we see here we only had 1 gap fill compared to 5 gap and goes, of which 4 were bullish. And so let's say that you gapped up on an earnings beat, you might already have the bias that you're looking for a gap and go and be looking for a reason to get into Roku on the long side. Right? And so for all of these, again, you'd like to add chart bubbles just so that we can easily go back and check and see when each of these instances happened. And so let's now add in our chart bubbles. And so we'll first create add chart bubble. And we'll say gap up filled. And so first we'll create a bubble if we had a gap up that was filled. And so we'll say close. And then if gap up filled and earnings miss, and so this is basically if we did end up filling the gap up based off of an earnings miss, then we'd like to call that out. And so we'll say gap up filled on. And this is how we can say line break. And so this way we don't have a chart bubble that's just going really, really horizontally wide. But we'll break it up into several lines so it just stacks. And so we'll say on earnings miss. And if that's not true, but we had in fact a gap up filled, which is why this bubble is plotting in the first place, then you know that it's just a regular gap up filled. And we'll give this the color cyan to match the first variable color that we had. Right? And then now let's go ahead and do the same thing, but for the gap down. And so we'll say, oops, wrong copy paste. So we'll say gap down filled, and then close, and then if gap down filled and earnings beat, then gap down filled on earnings beat, else we know that it's just gap down filled, and we'd like the color to remain cyan so that we just stay consistent with those labels. And then we'll create another set of variables for the gap and go on the bullish side. And so we'll just copy paste this just so actually let's use this variable down here because that starts us off in the right direction. And so we'll say gap and go bullish, close, and then here we'd like to say gap and go bullish. And if this is true, then we want it to plot in the same color where we had it to be color yellow. And so we'll give that the color yellow. And then we could also copy paste this one more time. And we'll say bearish, close, gap and go bearish, color dot yellow. And if, say, you didn't care about if these colors match the labels, then you might find it more appropriate to, say, give the bullish ones a color dot light green, for example, light underscore green or just green, and then maybe a color dot red or light red, light underscore red, sorry, for this chart bubble. And so that's completely your preference. We'll just leave it so that it color coordinates. Okay, and now if we click OK, this should be our first version of our earnings, smarter earnings indicator, right? And so now if we go back, what we can see easily on a glance is the one time that we had a gap fill was right here. The 5 times we had a gap and go, 1, 2, 3, 4, 5. And so now you may use this to say build your strategy around Roku based off of what actually happens once the earnings data comes out, right? And so there's not that much guessing here. You're really just playing probabilities once again. You're not taking the actual overnight earnings risk. You're waiting for that piece of information and that data, and then you're looking historically to see what has happened when that specific piece of information has hit that specific market. And so for Volatility Box members, we'll turn this into a scan. We'll turn this into some nice things, maybe a dashboard, and we'll send that out to you on Tuesday or Wednesday. But for everyone else, I think you can see how we can eventually start to build on this indicator quite a bit more as we start to notice more and more patterns. You may want to start to include your pre-earnings optimism stuff in here, but really I think there's better tools suited for that. And you can use this for sort of what some of those tools don't necessarily access, which is intraday data. And this might help you for, say, trading the actual day of intraday trading. And if you have a longer term pattern, for example, for a post earnings move, then you might use this to help you position intraday on the day of instead of having to, say, wait for the close of the day if that's when your data takes place, right? And so this is just one way that you might be able to use this indicator. Let's just go through a few quick examples just to test this out and see if it works. So one other company that we might want to take a look at is, let's say, Microsoft. And so we see Microsoft has had a total of 12 earnings on this chart, which is a 3-year chart. So 4 times 3, 12 makes sense. So total gap fills we see is 4, of which 3 have been a gap up, and so price has come back down. 1 has been a gap down, and price is filled back up. And then we see gap and goes. There have been a total of 5, all 5 of which have been bullish. And then we see that we already know that the earnings beat is built into the GNG. And so we know that, okay, it definitely beat on the earnings here. And it traveled to approximately 79 cents on average over the past 3 years every time we gapped up and then we continued to rise up. And so I think that's really powerful information. Let's continue to say maybe one more. We'll look at, say, TTD. And so TTD, we see 12 earnings, 4 total gap fills, 3 were gap ups, 1 was a gap down. On that of the gap ups, none of those were on earnings misses, so that's interesting information. The 1 gap down fill was on an earnings beat in which we filled that gap, so you know that you're 1 for 1 there. On the gap and goes, you see there's been a total of 5, all 5 of which have again been bullish for an average move of $12.02 from the open price, right? And we can see exactly where that is. So we gap down on an earnings beat. And so let's just see how quickly we can go back and actually see what happened, right? And so this earnings came out the next day. So we see that this is after market, and so we're using the next day's activity. Perfect. The chart bubbles on the right candle. We gapped down. This is where we opened, and then we filled this gap. Okay, so gap down filled on earnings beat. Did we actually beat? Earnings estimated was 53 cents compared to 65 cents actual, and so yes, earnings did beat. And this is how you can easily go back, see when that pattern was true, and you can compare it to what actually happens today. And you can also start to use sites like Estimize if you want to start to predict, or really build a scan in which you might be prepared for, say, any stocks that have earnings coming up in the next day. They all hit your ticker list, and then you go through each one to start to see, okay, well, are there any patterns that I can glean? Anything that I might want to asterisk to see if these conditions happen to be true after the earnings data comes out for whichever ticker you're looking for. All right, so once again, the indicator is available for free download on our website, tosindicators.com/indicators/smarter earnings. We hope this indicator helps you in your trading. I think it's a relatively unique take on most earnings indicators, which typically try and give you moves before or after earnings. But we're trying to focus specifically on the moment after you get that piece of data, the earnings data that we're looking for. And so we hope this indicator helps. We're going to continue to build on it, I think, as we start to notice more and more patterns. And so that's why we've given it this rather broad name of Smarter Earnings. We hope this helps you trade this earnings season a little bit smarter. If you start to notice more patterns, more observations, feel free to email them to us at contact@tosindicators.com. Once again, you can download the indicator at tosindicators.com/indicators/smarter earnings for free. All right, take care, everyone, and happy trading.